Hi, my name is James, and today I'm going to try and take you through interest rates, how they basically rise and fall, yeah? By the end of this, hopefully you have a very high understanding of how interest rates work, and you understand why Japan's in so much trouble. Okay, so this is Japan's slow bleed, the interest rate trap, and by the end of this, you'll understand this formula, and by cousin Gemma, which is me. Okay, so we have three banks, JP Morgan Chase, Goldman Sachs, Morgan Stanley. We have the US Federal Reserve right here. US Treasury General Account, so US Treasury's account with the Federal Reserve. We have the Fed funds rate being targeted at 1%, which requires about 45 billion reserves in the system. And this translates to a 1% interest rate, yeah? And it's tax day, 19th of September 2003, it's pre-2008. And currently, reserves, which is cash, yield 0%, and treasuries, which is government debt, yield 3%, yeah? So you want to hold as much as you can in treasuries and hold as little cash as possible, yeah? Okay, and so if you add up the total reserves, 5 plus 25 plus 15, we get 45, yeah? See what happens. So it's tax day, and Amazon has a bill to the US Treasury General Account, and it's 10 billion US dollars, and they only have 5 billion. So they need to go out on the interbank funding market or the federal funds market and basically find someone to lend money from, yeah? And Goldman Sachs offers, because everyone's got a lot of cash, they offer 5 billion at 1%. Morgan Stanley says, I got a lot of cash, I'll offer you 5 billion at 2%. And of course, they're going to take the lowest interest rate, and they set up this thing called a repo contract, a repurchase agreement, basically repurchase the debt or return the debt the next day, yeah? Okay, so see what happens here. The mouse go. Yeah. So cash is sent, reserves are sent, 5 billion to JP Morgan Chase from Goldman Sachs, and in return, JP Morgan Chase sends 5 billion in US Treasuries as collateral, yeah? So if they default on their debt, they've got the collateral. Okay, and now JP Morgan Chase has the cash to pay the US Treasury General Account and pay Amazon's debt bill. So their reserves leave the system. And if we add up the total reserves, 0 plus 20 plus 15, we'll notice a bit of a drop, yeah? We want 45, but now it's 35. Because this US Treasury General Account is not a part of the banking system. So first, JP Morgan Chase sells some treasuries to Morgan Stanley so they can get some cash up. So 10 billion they sell. And then they buy up, well, now they have 10 billion cash, yeah? So they sold it. They didn't do a repo. They actually just sold the debt to Morgan Stanley, yeah? And this is what, and then we have this thing called the overnight. So every night, the Federal Reserve will try and bring back the supply of reserves to this area here, 45 billion. So we get this 1% interest rate target, yeah? It's an overnight funding target. And what this means is they basically take treasuries out of the system, or they buy treasuries from banks and give them cash, essentially. It's that easy. So if you look at the total reserves now, after they took the treasuries out or bought treasuries off Goldman Sachs and gave them cash, 10 plus 30 plus 5, we got 45. So they've basically taken 10 billion treasuries out and added 10 billion reserves in, or 10 billion cash in. Okay, so the next day, JP Morgan Chase pays Goldman Sachs back the cash for the repo contract, and they get their collateral return. But they need to pay the interest as well. That's the key thing here. So that's why it's 4.9 billion, not 5 billion. And yeah, so they get the interest, and that's over 365 days, because one day, remember? Yeah, next day, or same day, the US Treasury General Account, or the Treasury, spends, let's say, what was it, 10 billion? Yeah, 10 billion on defense. And this goes, and one of the contractors is banked with JP Morgan Chase. And 10 billion goes to JP Morgan Chase in that reserves account, yeah? So they bank on behalf of this new contract, let's say it's Bravo. Okay, and because the reserves now increased, we look at this, go back here, we had 15 plus, so 50, 55, so it's 10 over with the target overnight funding rate wants to be. The Federal Reserve steps in and now takes basically reserves out of the system by selling treasuries back to Goldman Sachs, yeah? And Goldman Sachs wants these because they have interest, and this has basically no yield, remember? No interest. So they want to get as much interest as possible. They don't want too much cash. Maximize returns, yeah? Okay, the United States inflation rate is now going up, So the Federal Reserve wants to raise interest rates. So they need to take reserves out of the system, and this will push interest rates up. And this is in 2006, yeah? Fast forward a bit of time. And what happens here? So the Federal Reserve now sells treasuries back to the banks. And what this does, increase the number of treasuries, but it also takes cash out of the system because they need to buy these treasuries from the Federal Reserve, yeah? And what happens is now we have 12 billion, this 12 billion tax bill, same scenario, a little bigger this time because of inflation, or they got more earnings, and exceeds 10 billion in reserves that JP Morgan Chase has, yeah? So they need to go out on the interbank funding market again, or the federal funds market, and see what they can get. But unfortunately, because the amount of reserves is less, we have less buyers, yeah? These banks represent 3,000 different banks, not just 3, okay? And yeah, so they get a $5 billion offer at 5%, and this is the best offer they can get. So now we have another repo contract signed at 5% for $5 billion, yeah? Now JP Morgan Chase gets their cash, and they send a collateral to Goldman Sachs. And they can pay the tax bill on behalf of Amazon to the US Treasury General account, yeah? And this has reserves leave the system. So now the Federal Reserve needs to add reserves back overnight in the overnight funding facility, open market operations. And this, what it does, now they boost back up to 35 billion, yeah? So 17 plus 8, 25, plus 10 is 35, yeah? So go back there. And now, what happens next? We have this new contract. Oh, so no, JP Morgan Chase just repays that contract, yeah? Plus the interest, see? But now it's 5% interest, yeah? A lot more cash, 685,000 US dollars just to borrow cash for one night, yeah? 5 billion for one night. And now, US Treasury General account now spends another, 12 billion on defense, and this goes to JP Morgan Chase, the same contractors banks with them. So the reserves increase in the system. So now the overnight facility needs to take cash out to bring it back down, so we have 35 billion still in the system. Okay. Hopefully so I understand. So basically they'll sell treasuries, this will boost treasuries, but they need to pay for it in cash, and this will boost or get the balance of reserves back down to 35 billion. Okay, so now we're into 2008 during the height of something called the GFC, and the Federal Reserve wants to lower interest rates all the way down to zero. How does it do this? So what it does is it basically buys up all the treasuries, or as much treasuries as they can, to get interest rates to zero. And this pushed a lot of cash in the system because they're buying these treasuries from Goldman Sachs, and they're paying cash, so more cash comes in the system. This pushes interest rates, so cash goes up, and this pushes interest rates all the way to zero. And now, let's say JP Morgan Chase wants to get 14 billion, because they're still for the tax bill, yeah, for Facebook's tax bill. And unfortunately, there's zero offers, even though we got 25 billion, a ton of cash. And why might that be? Well, that's because of these mortgage-backed securities, yeah? A lot of banks have had like 35 to 45 leverage, or 40 times leverage. So for every 1% move, they'll make a tiny amount, but very quickly, for a 1% move, like downwards, let's say the value of this went down by 1%, say 6 billion, they'll lose half their balance sheet. Like there's a 40 times leverage, yeah? Okay, so we had zero offers because everyone thought the banking system was going to go under, so no one would lend out money, so the whole credit system, the whole financial system basically came to a halt, even though interest rates were at zero. So this is a massive problem, yeah? So what does the Federal Reserve do? They force to print up cash and basically buy all these mortgage-backed securities off the bank's balance sheets at full price and transfer it to their own. And this floods the system with cash and reserves, so that basically banks won't need to go out into the interbank funding market or the federal funds market. They already have the cash available, and now they can pay their thing. Now, if you look at this balance, this is a central bank balance sheet. As you see here, this is the mortgage-backed securities. That's what we're talking about, yeah? Okay, what happened next? So they use this cash to buy US treasuries, okay? So let's use this cash, it goes in here, and in return, they send them out more treasuries, yeah? So they're buying treasuries from the US Treasury. And what happens here? Well, that's government debt, yeah? So increase the amount of treasuries. And as you can see here, post QE, so the first QE was all focused on agency mortgage-backed securities, yeah? Real estate bonds. But after that, it was mostly mostly treasuries, yeah, a large amount of treasuries to buy government debt to fund deficits. If you see here, it was 3.5 trillion printed in total up to about 2014. So here's the federal funds rate at 0. So this is the money printing, yeah, it shifts the graph to the right. So we went from 6 billion reserves to 3 trillion. And if you notice something here, now they printed up, this is the 1.7 trillion US treasuries they printed up. So they basically just bought all these treasuries from the banks, and then the banks and all these reserves end up here to fund basically the government deficits, yeah? So they would buy debt, and this is an increased debt here for treasuries, and then the US central bank would print out cash and then buy these US treasuries, yes, and transfer it to their balance sheet. So it's like a feedback loop. So these guys would issue it, these guys would buy it, and then these guys would print it and buy it. The problem is now when Facebook, or let's say JP Morgan Chase needs to pay Facebook's tax bill, they've already got a ton of reserves. So they're not going to go out into the market. So there's no demand, right? No bank's offering. So no bank wants actual cash. They've already got it. And also, Morgan Stanley and Goldman Sachs have got that much cash they want to lend out at any rate. So the problem is interest rates are always stuck at 0 because there's 0 demand for cash because they've already got it, and there's already infinite cash. So there's infinite cash to give. So everyone can. So the problem is interest rates are always stuck at 0. And if you look at this, this is the Federal Reserve balance sheet. So as we noted, this is pre-2008. So we had 745 billion US treasuries, yielding about 3%. And by 2014, we had about 3.5 trillion printed, 1.7 trillion in mortgage-backed securities, and 1.7 trillion in treasuries, all yielding about 3%. So interest income from all these bonds, it's called the interest income for the US Federal Reserve, was 116 billion in 2014. Interest expense, which is what we're about to talk about in a sec, was negative 6.7 billion. And earnings remit to the US Treasury. So basically any surplus they have between these two, they'll pay to the US Treasury, and this will help bring down a deficit, yeah? Okay. So this is Carlos Njamo. He's currently unemployed, but he has a few offers for the banks. We have Bitcoin Liberty Wallets, my company. It's currently, I believe, worth 3 billion. And it's 40 billion. I go to the bank, I ask for a loan for 3 months, and because I've got so much cash, they just take it. And this is what we call driving speculation. When interest rates are at 0, max speculation happens, and everything skyrockets in price. Yeah, company values go off the charts, housing prices go off the charts, yeah? This is why having this much cash, because interest rates are always stuck at 0, so I can always get a loan very cheap. This is in the short-term market, yeah, not long-term. And let's see what happens next. So the Federal Reserve needs to create this thing called the interest on excess reserves. They need to disincentivize banks from lending out to or putting their cash into high-risk investments, such as myself, because think about this, there's no way this stuff's worth anything. So the interest on excess reserves created, basically they'll pay 2.5% to all these bank reserves, yeah? 1.8 trillion currently. And actually, yeah, okay. They're paying 1.8 trillion to all these reserves and 2.5% on the 1.8 trillion. It's a lot of money, yeah? And this basically disincentivizes them from lending to me at 0.3, because why would you lend to me at 0.3 in a high risk investment when you get 2.5% on interest on excess reserves for free? Yeah? You're going to lend to the central bank. You're not going to lend to me. You're getting 2.5%. So now my interest rate goes up to 2.5%. See, it was 0.3, and now it goes to 2.8%. And they might still lend to me, but it does definitely bring down the values, yeah? My valuation, well, I went bankrupt because of the high interest rates, and my portfolio valuation went from 40 billion to 3 billion. It's really not that big of a jump, but I'm just doing it to show you what happens, how interest rates bring down valuations. But now if they cut interest rates, say 1.5%, this brings down the short-term rate to 1.8%, yeah? And now this should bring interest rates back up, but this should be going up again. But yeah, you get the idea? And okay, so this is the Federal Reserve balance sheet in 2014. So the interest on excess reserve expense is now 6.7 billion. Okay, we already took that. Okay, look at the difference, eh? In 2018, the interest on excess reserve expense was 43 billion. Yeah, so they're paying one point. I think it was 2.5%. 2.5% on all these reserves, which equates to about 65 billion US dollars. Oh, sorry, 43 billion US dollars, which is still short of the 112 billion US dollars they receive from all their printed up balance sheet and also the usual balance sheet. Yeah. So in total, they're getting 112, but the interest expense is getting higher. Yeah, because the reserves in the system are getting higher. As the reserves get higher, and the difference between the interest and excess reserves. Actually, wait, we'll explain that later. Okay, so you see, at 5.5%, they're paying interest in all these reserves to disincentivize banks from lending out to high-risk short-term investments, yeah? And what this does is, we got 3.2 trillion at 5.5%. The cost to maintain this interest on excess reserves is 176 billion US dollars. A lot of money, yeah? And as you can imagine, as this amount goes up, this amount every year to maintain these interest rates goes up. Remember, before 2008, interest rates were controlled by the supply and demand of reserves. Now they're controlled by the interest on excess reserves, because the central bank has to basically disincentivize all the money they printed from being lent out at really low interest rates and basically causing high inflation. They have to pay them this interest rate. And the question is it sustainable? And you might be thinking, probably not, yeah? The reserves keep going up into the trillions. This amount's going to get bigger and bigger and bigger, yeah? And it's more so if this interest rate's different from the interest on the central bank balance sheet. So you see how this is 5%, this is 2%, and it's also going down. It means that the difference between this is what the central banks have paid. And look at this, ready? So in 2024, the interest income was 159 billion. The interest on excess reserve expense was 186 billion US dollars. And the Fed's overnight reverse repurchase market, or the Fed's on repo, is negative 40 billion. That's for money outside the financial system, outside the banking system. I'm not focusing on that in this lecture. I'm only focusing on the money inside the banking system. So that's 186 billion. And you can see that the Federal Reserve needed to print up 77 billion to maintain the interest on excess reserves and the Fed's on repo, yeah? Don't worry about the Fed's on repo. Okay, so 242 billion US dollars being printed since about September 2022 to maintain the interest. Basically, they're going into a loss. So now this is costing more. So before they were getting more interest income than they were on the interest expense. So they had a profit, yeah? And they could send that profit via earnings remitted to the US Treasury. And basically this helped go paying off the deficit. But now it's exceeding the interest income because they're basically having to, remember that? They have to basically print up 5%, or basically print up 5.5% to pay to all the banks so they don't lend out to other people because there's just so much cash in the system, yeah? Okay, so why no inflation? You might be thinking they're printing up this money, it should cause inflation, yeah? But the thing is, you need reserves are different. So you have base money and broad money. So base money won't affect inflation, like core inflation or CPI inflation, but it will affect the quantity, the supply of reserves. Yeah, so when I'm saying inflation or inflationary, I'm talking about the supply of reserves going up. Yeah, so, which is a big problem. You'll see why. Okay, so we saw the balance sheet, the interest rates are going down because whenever they're doing these quantitative easing programs, they're buying during a recession when interest rates have already been cut to zero and all the debt's come down, yeah? So they're buying at very low rates. So since September 2022, 242 billion has been printed by the Federal Reserve to maintain the interest on excess reserves. But the Federal Reserve is conducting passive quantitative tightening. So this is quantitative tightening, when the Federal Reserve's balance sheet's shrinking, and basically they're printing up, or not, they're selling treasuries, not selling treasuries, they're letting it roll off. So there's a difference between passive and hard quantitative tightening. So they let them mature. So let's say you get a 10-year bond, a 10-year US Treasury, you hold it for 10 years, and then at the end of 10 years, the US Treasury will pay the central bank back, and this will end the Treasury. The central bank balance sheet will decrease. But if you just sell it, like you buy it, and you only hold this US Treasury for 1 year instead of the full 10 years, basically that's hard QT. You're basically selling instead of holding for the full duration. So quantitative tightening, about 60 billion treasuries and 35 billion mortgage-backed securities per month, letting bonds and debt mature and not renewing it. So instead of repurchasing it, once the bond expires, they they just reduce the balance sheet. So that's this coming down. And as you can see, that's what they're selling. About 60 billion treasuries and 35 billion mortgage-backed securities. And as you can see here, so the QE minus QT was 198 billion, yeah? And the 77 billion was the money printed from the interest and excess reserves. So this minus that, it's still deflation, yeah? There's still reserves coming out of the system. But as you might imagine, if the interest and excess reserves begins to explode, I actually got this formula wrong here. Okay, so difference. So look how big the difference is. So interest and excess reserve expense was only 6.7 billion in 2014 when interest rates were at 0, yeah? And now it's 186 billion, or actually 220 billion, because you got to maintain both. So we can see that this might be getting unsustainable if this keeps going up and the number of reserves go up, yeah? So passive quantitative tightening and the limits. So this is quantitative tightening, this decrease in the balance sheet when they're letting basically the reserves roll off naturally. They're not selling, they're just letting them roll off. What happens here? So the average bond duration is the biggest limit for a central bank balance sheet. The longer the duration, the slower the roll off. You think about it this way, if the bond takes 14 years to roll off the balance sheet, it's going to be on here for 14 years. It's going to be very slow. But if it's only on here for 2 years, the decrease is a lot faster, and you'll see in a sec. So the United Kingdom has a 14-year duration, average duration for their bonds. Bank of Japan, 10 years. The Euro area, 7.4. United States, 7. And Australia, 6.6. So passive quantitative tightening limits. As you can see here, because Japan has a 10-year, its roll-off is incredibly slow. But if you look at Australia's, it's 6.6. And see how fast it decreases? They're both doing passive QT. Passive QT is just letting bonds mature and not renewing them. Yeah? And look at the big drop. So 10% drop from passive QT and 38 from passive QT. Massive drop. 4 times, yeah? And what this means is, this is the United Kingdom, okay? So this is what how QT looks like when bonds get sold. Look how quickly interest rates spike on long-term treasuries or long-term gilts when the central bank conducts quantitative tightening, yeah? So this is because they're directly selling debt. They're not letting it mature. Basically, the thing about it, you have a 10-year or 30-year treasury or 30-year bond, and you dump it on the market, it's going to spike interest rates because you only held it for a year. You didn't hold it for the full 10 or 30 years. So you can get rid of your balance sheet can reduce faster, but you're going to spike interest rates on all your long-term debt. Okay, so this is the future. So let's say we have a QE AI bubble or invasion of Taiwan, and this requires a ton of money printing. And now the reserves increase to 6 trillion. So look at this, 2 trillion, 2 trillion, 2 trillion, yeah, in reserves. And of course, let's just say hypothetically, this is a very unrealistic interest rate, but I'm just trying to show you how quickly these costs can go up. Yeah, so let's say we have a 30% interest rate. Can they actually raise interest rates to 30%? This is the question. So 6 trillion at 30% is 1.8 trillion US dollars a year to maintain. They're going to pay the banks. So this is getting paid to the banks, interest to the banks, so they don't lend out to me. Yeah? And let's think about it, yeah? 1.8 trillion US dollars a year. Interest income is 300 billion from the Federal Reserve's balance sheet. And we've got quantitative tightening of 1.2 trillion a year. So we put this into the calculation, we get about 1.8 trillion minus 300 minus 1.8. So we get about 300 billion US dollars worth of inflation. So the Federal Reserve will need to conduct hard QT on top of basically raising interest rates and passive QT to make sure the supply reserves are not increasing. So remember we showed you that this spikes interest rates, and it can actually cause, you think about interest rates getting spiked and this interest rate's going up even higher, you might think this balance increases and it can cause a bad feedback loop, yeah, the death. Okay, the interest and excess reserves. So it's just the number of reserves times the interest rate, yeah? And as you can see, the reserves is going up since 2008 because they printed a ton, so this is going up. And the inflation rate has been relatively low, but imagine it got up to, like, say, 10, it got to 9 almost, I think. And imagine it got up to 20%. Now you put those two together, the cost is just enormous. Okay, let's talk about Bank of Japan. Okay, so they're conducting passive QT. and yields are still rising pretty quickly, yeah? So annual passive QT is 270 billion, and average bond duration is very long, 10 years. Yeah, remember that's a problem. It takes forever for the bonds to roll off. And we're seeing 10% basically passive QT, yeah? Reduction in the balances, that's 10%. Okay, the problem is in Japan is that inflation's at 4%, and they have a problem with the debt GDP ratio. So they're going to keep interest rates low, but inflation's running hot. So no one's going to buy a bond or debt that's yielding 0.5% and accept inflation at 4%, yeah? They want to make profits. You actually want to be in the green up here, yeah? You want to be making money. You don't want to be losing. Oh, shit. Okay, so Japan's debt to GDP ratio is around 235%, yeah? Not 255. But what this means is the interest payments are already very high. Currently, 16% of Japan's annual tax revenue already goes to interest on the national debt. And at around 53%, it's about, well, at 3% interest rates, is around 53% of annual tax revenue goes towards interest on the national debt. And as you can see, as interest rates spike in Japan, debt rolls over to higher interest rates. The average weighted interest rate on the entire national debt is 1%. And as these yields are higher, these long-term maturities will roll over to 3% and 1% over the next 30 years and 10 years, yeah? And eventually, the central bank balance sheet, the cost will go up to around 53% of the entire tax revenue of Japan, which is unsustainable, yeah? So obviously, interest rates can never be raised because they will destroy the Japanese economy, yeah? So annual passive QT for Japan, it was negative 270 billion. Interest income from the central bank's balance sheet is about 16 billion. And currently, interest on excess reserves is the amount of reserves in the system in Japan. So 580 trillion yen, and times 0.5%. So the current interest rate is 0.5%. So this is the cost, yeah? So the cost to maintain this is 19 billion. So currently 19 billion minus 16 billion is only about 4 billion in inflation. So if you minus the actual reserves in the system from, so this is quantitative tightening, passive quantitative tightening minus the 4 billion, yeah? And what this means is you're getting deflation, which is good, yeah? But the problem is, let's look at it this way, yeah? So we've got the same passive QT, but we have 8%. Now the central bank wants to raise, let's just say they can't do this because of the GDP ratio. But let's say they did. They wanted to raise interest rates from 0.5% to 8%. What would the cost be per year? Well, it's 580 trillion in yen times 8%, which is 46.4 trillion yen, or 309 billion US dollars a year. Now you got to minus away the interest income, yeah? So the interest income from the central bank's balance sheet, and they get $293 billion of inflation caused by the interest on excess reserves. And what happens here is now we have QT. So QT minus the new reserves created. And this is basically $24 billion worth of inflation. So now basically passive QT is not enough. And the central bank will need to conduct hard QT, like selling bonds. So this number of reserves in the system is not going up. Hopefully that makes sense. But obviously with the debt to GDP ratio of 235%, the Bank of Japan will never raise interest rates to 8%. This is just showing how quickly it becomes inflationary. Because nobody but the central bank will accept negative real returns, so interest rates on government debt will creep upwards unless the central bank buys more debt or government bonds. But this isn't free. The central bank balance sheet will need to increase. The total estimated cost is around $382 billion a year. Yeah. Okay, so this is what happens. Yes, the central bank will need to bring interest rates back down to 1% for long-term maturities, and they do this by printing out money, yeah? They expand the central bank balance sheet, and they buy government debt from banks, who buy government debt from the government, yeah? Basically, direct debt monetization, yeah? Let's look at this, right? So now the interest on excess reserves expense. Okay, reserves times interest on excess reserves rate. So this is what the current rate is, and this is the future. So if they want to maintain, remember, it costs about $382 billion to keep interest rates at around 1%, or 0.5% around that area. So the central bank balance sheet will need to go up. So the reserves goes up. And let's keep the interest rate up around 1% forever. And as you can see, very quickly, this amount of interest on excess reserves slowly creeps up. And eventually, what you'll notice is actually these two start to cancel each other out. So if you want to keep interest rates at 1% forever, they'll basically cancel. The interest income on central bank's balance sheet will be 1% because all the bonds are basically yielding 1%, and the interest on excess reserves is 1%. So two of these cancel each other out. Yeah, so to zero. But what doesn't change is the total reserves keep going up. Because quantitative easing, central bank balance sheet needs to keep being expanded to buy government debt. They can't allow these, especially if inflation's up 4%, they can't allow these bonds to rise because of the high debt GDP ratio, yeah? They'll go bankrupt. So they'll keep it at 1% and ride it out for infinity, essentially, yeah? But the problem is this thing called Japan's problem is that they need to basically keep increasing the total reserves, yeah? And inflation is constantly at 4%. Let's say it can be even higher. This is just a base case scenario, a good scenario. It's always at 4%. They're going to maintain interest rates at 1% for infinity. So for Japan, the average deficit is about 5.7%. And the problem is this will actually increase debt GDP ratio. Because remember, they're buying government debt. And if GDP doesn't increase, but now also remember Japan's declining birth rate and declining productivity with age. So the debt GDP ratio could actually explode even higher than this. But what you can see is things get really bad real quick. So instead, basically at 1% average cost, 23% of the current tax revenue at 292% goes towards basically paying interest on the national debt. Yeah. And that's all I really wanted to show you. Thank you for watching.